From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for October 13th, Friday the 13th, 2023. Checking the calendar, the Packers are off again this week. They have a bye. The Bucs are in Los Angeles and Oklahoma City for a couple of preseason games. And the Milwaukee Brewers, well, wait till next year. Okay, here we go. In Canada, a black bear walked into a gas station bar, took a pack of gummies, and left. Of course, without paying. If he had paid, we wouldn't be talking about it. Speaking of black bears, apparently bears can join the Naples, Florida Yacht Club. Last week, a black bear was spotted on a 50-foot catamaran docked at the yacht club. That sounds like an episode of Gilligan's Island. This next one is about as strange as I've ever heard. In Peru in South America, a man was found to be carrying around an 800-year-old mummified corpse in a food delivery bag. It couldn't possibly be a DoorDash, could it? Finally, let's hope this next guy isn't doing delivery of any kind. A man driving a tractor in Pennsylvania was arrested for driving under the influence just 17 minutes after he was released from custody for the very same thing. Yo, buddy, let me tell you about my friend Bill W. On the podcast today, we have Steve Giles, Kendall Bauer, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
And a bit of an interesting week overall. The S&P finished the week up 0.4%, closing at 43.28. The NASDAQ, however, down 0.2%, down 24 points this week, closing at 13.407. And the Dow Jones Industrial Average, the big winner on the week, up 263 points to close up 0.8%, closing at the bell on Friday at 33,671 for the year. However, the Dow still lagging the broader markets, up just 3.3%. The S&P up 14.1%. The NASDAQ, despite a down week, still a stellar 28.9% positive return, all including dividends. For the week, meaningful move lower in Treasury bond yields. Steve, in particular, on news last weekend of war breaking out in Israel. I think signs that the global stage is now fleeing to U.S. Treasuries in hopes of seeing some safety there. We see this pattern tend to emerge in times of war breaking out in parts of the world, but some needed cover potentially for bond investors who have been getting hit by higher interest rates as a result of the Fed's fight against inflation. As you kind of look at the landscape right now, what are you seeing from investors, kind of looking for preservation?
Well, yeah, I do think that there has been a bit of a flight to safety here this week, Kyle, in light of world events. And certainly there is a lot of uncertainty surrounding what's going to happen here over the next few days and weeks and months in the Middle East. But that shouldn't distract us here in the United States from what is ultimately the same old, same old. For us, what moves the markets longer term is going to be interest rates and earnings. Earnings continue to be better than what many companies are expecting, or what they've been reporting are better than what analysts are expecting. And with where interest rates have been headed, I think the slight pullback this week has not deterred the longer-term trend of interest rates across the board going up. We're starting to see a yield curve that is suggesting that the bond market itself is kind of doing the Fed's work for them. The Fed had been talking for a long time about not being done raising rates, that they might have one or two more rate increases in them over the next couple of quarters. But with where bond traders have sent yields in that intermediate term range, they may be pushing rates to a level that is going to cause the Fed to maybe not have to raise rates, which I think is an interesting proposition as we turn the corner into next year.
Yeah, higher for longer, perhaps the words we'll be able to say for quite a bit now. The transitory of late 2021 into 22, and the days of extremely high inflation, hopefully far behind us now. But where do rates go from here? They probably stay up, maybe not as high as they can go, but higher than what we thought for a while.
I do think it's interesting that the interest in short-term CDs and high-yielding money market accounts has begun to increase as of late. And I think a good reminder to our listeners is that the shape of the yield curve right now is suggestive that rates currently at this 5.25%, 5.5% range on money markets and 4, 5, 6 month CDs is probably not going to be around for much longer. I think it's important for investors to not fall victim to the tying their money up into short term of a product for fear that when that issue comes due in 9 months, yields will be much, much lower. Ask yourself the question before you buy that 1 year CD at 5%, where will rates be when you want to re-up that CD after it comes due? We're starting to talk about lengthening durations on our portfolios. Obviously, Bob mentioned that at the seminar. And for those investors who have a longer term time horizon and can hold on to those bonds for a little bit longer, locking in a higher yield for a little bit longer makes a lot of sense when yields start to fall.
No, Steve, I think that makes perfect sense. And Kendall, I know you've had these conversations at length. I'm sure you've got some thoughts you want to share.
Yeah, just to piggyback, Steve, on what you just said, I think the other upside, too, of not pigeonholing yourself necessarily into something like a CD or treasury where you have to make a decision upon maturity. One of the benefits of things like mutual funds, ETFs, index funds is the upside that they will receive when the Fed begins cutting rates as well. You lose that if you are sticking too short on the duration curve. So another thing to keep in mind.
Can I ask how much do bond fund managers adjust those durations?
They are constantly looking at the market to get an understanding of, and in particular with respect to the yield curve, to get an understanding of where should we be positioning this portfolio for the best opportunity for our investors. And the caveat there is that if you run a mutual fund, you are mandated based on the language of your prospectus to a particular objective. And so that might mean that you look like the bond market in aggregate, the aggregate bond index. It might mean that you're plus or minus 1 or 2 years the duration of the index if you've got a little more latitude, or it might mean that if you've got wide latitude to invest across fixed income, that you can pick and choose your spot. And what we've seen largely is that as interest rates have come up more broadly, there are bond portfolio managers out there that are saying, all right, I love the interest we can get on these short-term bonds, but we know that's fleeting. And we know that 6 months or a year from now, if interest rates have come back down even a little bit, we would have been happier capturing those high rates that exist on a 5 or a 10-year note, not just the 1-year note, because it means we're getting paid that for the next 5 or 10 years. And so I think this is an opportunity for many investors to say, let's lock this in beyond just today.
For those investors, Joel, that have shorter duration bond funds that might be in the 2 to 3 year range, consider that those funds have stuff that's coming due more frequently. So they're able to re-up their yields to the now higher prevailing rates. Unfortunately, as Kyle mentions, by prospectus, they really can't go out past 3 or 4 years. So the only way for investors to garner the higher yields for longer is to go into a more intermediate or longer duration bond. And even those bond funds have prospectus language such that they really can't go out past what's in the prospectus, but you really don't want to. Longer term bonds are just much more volatile. We're talking about intermediate and long-term durations that I think peak out in the 7 to 8 to 9 year range. You start getting double digit on your bond funds, and that's a very wild ride when rates start to move.
And important to remember that inverse relationship between bond prices and rates. So, to your point, Steve, a 10-year duration bond fund, if we see an interest rate move higher of just 1%, that's a 10% decline in the price of your bonds. And so when we're talking about our safe money, one of the reasons why long-term for us isn't a 10-year bond portfolio, it's a 6 or 7, is because there is still that sensitivity of what if we're wrong, what if rates can go much higher from here.
Engaging from the Fed's dot plot, they're expecting to settle into a rate somewhere in that 2.5% to 3.5% range. Well, that's 2 percentage points lower than where we are now, 3 percentage points lower than where we are now. So, Joel, if you have a 5-year duration bond fund and the Fed moves from 5% in an overnight rate back down to 3%, that 2% fall in yields just gave you a 10 to 12% increase or price reappreciation in the underlying bonds that you own, because the math works both ways, to the negative and to the positive when rates are falling.
So, Kendall, we're talking a lot about bonds here, but there's a lot going on in the stock market as well this year. The NASDAQ, kind of more growth-heavy version of broad indexes, up almost 29%, including dividends. The Dow or the S&P, a little more narrowly focused, not up quite as much. And then you look at maybe value stocks that have certainly been the laggards with respect to kind of the growth and value conversation, at least year to date. And then you start to look at some longer term numbers and maybe the story starts to change a little bit.
Yeah. Interestingly enough, value has actually outperformed growth over the last 3 years. I looked this up and by about 150 basis points. So you may see your next statement coming out for last month and see value stocks maybe a little flat and your growth stocks up pushing maybe 20%, and say, hey, why do we own this? Or ask your advisor, remind me again why we own this when it's so far behind. Well, because when things head south like last year, in most cases, that was the star performer on the stock side of your portfolio. So I think we have said this more than enough times on this podcast. You want to own both, and it's why we preach the balanced philosophy that we do. Even when things may not look so great year to date or falling behind, sometimes it's worth backing up a little bit.
Well, and increasingly, I think the conversation that we're now having is not value or growth, but in changing how we define value and growth, right? That I'm not willing to pay through the nose for a high-flying growth company. I want to get a good deal when I buy it. And so that follows some of the traditional value principles, but they don't neatly fall into the value index. And as a result, I think the path forward is less about kind of the traditional definitions of value and growth and more about buying those high-quality businesses that have some growth prospects, but that we can find at a reasonable price. You buy something on sale, you're usually going to look pretty smart down the road, especially if it's a business that's going to be around for a while and doing good sales. You know, Joel, we got a pretty important number for somewhere between 65 and 70 million Americans that count on Social Security for, in most cases, a meaningful portion of their retirement income, and that is the cost of living adjustment that we're going to see for 2024.
Yeah, Kyle, the Social Security Administration came out with their announcement on the cost of living adjustment for next year, and it's 3.2%. So that's affecting, like you say, about 70 million Americans, and on average, that's $50 more a month for benefits.
I'll take it. I mean, if it's only 50, maybe it's not quite enough. It comes on the heels of what was a much more substantial increase in the prior year. And certainly, I think when you look at the inflation numbers and go, well, we were here, this isn't nearly enough. Well, remember how the formula works. It doesn't just say, here's the exact math on inflation. It looks at a very specific data set.
And there's that lag in there. I think a year ago when the Social Security announced that it was going to be 8.7% for 2023, which was the highest in 40 years, I said, well, wouldn't that be nifty if inflation went down and you're getting a 9% raise and inflation is half that or less?
And I think the question that you had posed to kind of us as a group ahead of the meeting today was more about what happens with spending as we get into those years in which Social Security is a bigger part of what we do. I mean, feel free to kind of ask the question a little more clearly, because I think it's worth getting out there. This is kind of the transition that we're looking at as an economy.
Well, yeah, as an economic story, I've been reading more articles about how, I mean, we always talk about how spending is important to our economy. And so there's concern that the economy is slowing down. And so what if it slows down too much and goes into a recession? And there have been some articles that have pointed out that, well, you don't have to worry because senior citizens, people over 65, have a lot of money and they don't have to worry as much about things like high mortgage rates or student loans or, a lot of the things that younger people have to worry about. And so they're sitting on a lot of money and they can help spend us out of a recession and or at least make that recession a softer landing. And so my question to all of you was, what kind of discussions you're having with clients about that? And those over 65, those who are retired, are they actually of a mindset to spend more money?
And I think broadly speaking, the answer has been the spending doesn't change all that much. It did, right? Immediately following the pandemic, you had this pent-up demand. I don't think that's completely off the books yet. I think there's still folks that I talk to who say, well, I didn't quite do all the things I wanted to do my first couple of years of retirement because I couldn't, because I didn't want to, because I was concerned about the health risks. And so they're piling that stuff on now. But broadly speaking, it's not a drastic shift in spending. It's a confirmation that I'm not counting on my employer anymore to support that spending. And I think when we talk about the risks of a hard landing from what the Fed is trying to accomplish, which is raise rates to slow the rate of growth, the one thing they have fighting them is, well, you got a large portion of the consuming population now that isn't dependent on interest rates. And so maybe one of the reasons why a soft landing is more likely this time around is because of the number of people that they're spending because they can, not because they're still working, not because they know they're comfortable not getting laid off, but because they don't have to worry about the job picture, period. And so they need a new car, they're going to go out and buy it. They're probably not all that concerned about interest rates because they've saved their whole life so that they don't have to borrow to buy that car. More importantly, they don't have income coming in the way they used to, and so they probably don't want to tie themselves down with a house payment, with a car payment, with the kinds of things that when you're working, maybe you can't afford it all up front, but you know that as long as the economy's strong enough, you're going to be able to support those payments along the way. And so I think there is a lot to be said about the nature of this economic cycle, dependent upon a population that has clearly aged, that is entering those retirement years. By the way, household net worth, the data point we threw out at the seminar this year, back to record levels, in part because of the strong market recovery we've seen the last year. Well, one of the things that those retirees care more about than they do about the labor market is, how does my portfolio look? Is my house worth more money? And what's my cost of living adjustment on Social Security going to be? All three of those things support, I think, more confidence in spending than what we might see if we were counting strictly on the labor force.
Is there advice that you typically give clients or that they ask for as far as spending? And we talked about revenge spending. Have we seen much of that among retirees? And did it go out of bounds and you're trying to help rein it back in? Or
I think what I've noticed, Joel, in a lot of my meetings is folks eager to get back out traveling after the pandemic. What's interesting, I think, is people love to complain about the cost increases in the day-to-day purchases, right? Going to the grocery store costs you another $100, looking at furniture, vehicles, whatever it is, yet they continue to spend money. So being able to, I think, absorb some of that increase in cost and, frankly, all the rate hikes we've endured, I think that generation, the baby boomers, we're in a position to kind of weather the storm. And I think that has helped lift the economy, or at least carry us through, a substantial rate hike campaign by the Fed.
Well, and I think, the critical piece of this is that there was so much you couldn't do for so long, that when we talk about the inflationary pressures that are out there, it was in part because you had, Joel, as you said, that revenge spending that kind of chased goods and services. First, it was the goods because that's what you could buy. You rebuilt the basement, or you refinished the basement, you put the deck on the house, you repoured the cement because you had money sitting on the sidelines that was committed to something else, but that something else you couldn't do. Then we saw kind of chasing some of that services spending. I think there's still some of that out there. Certainly as I talk to clients, I hear, well, we didn't get to travel with the kids, or we didn't get to see our kids, or we didn't get to do that one trip we really wanted to do. I do see that starting to tail off a little bit. And, Steve, I know you've talked in the past about allowing some flexibility for spending in the years kind of coming out of COVID, because it was stuff that maybe people had been waiting to spend money on.
Oh, absolutely. Pre-COVID, I think it was part of our responsibility to give clients the courage and the confidence to take money out of their retirement portfolios. It's so hard as an individual, as a saver, to go your entire life saving, growing. Do I have enough? And when you finally pull the trigger and realize that you're retired and you don't have a paycheck coming in and you have to still spend money, that's a hard transition to make. And so when you build these portfolios and you talk about withdrawal percentages, part of how I help clients gain the confidence to spend that money in retirement is to just do the math, right? Hey, if you have $1 million saved up, don't take more than 4 or 5% out and do all the trips you want. I don't care how you spend it, but if you're worrying about how much you're going to spend on your trip, I think that's the wrong question. It's how much of my portfolio do I have to take out to afford these things that I want to buy?
And I think the final piece of this that I always come back to when I'm talking to clients about not just the spending aspect of retirement, but the saving aspect of retirement, is none of this comes in a straight line, right? You don't pick a dollar amount and say, this is the amount I'm going to spend every year or save every year forever, because opportunities come up, costs come up, challenges come up. And so we got to take those things as they're happening. And, Steve, I think you hit the nail on the head. It's here's the number. And now, what happens when we change that number?
Oh, COVID was awesome from a savings standpoint. People were all stuck at home. We couldn't spend. We had to save. And why do you think that inflation was such a big deal when we came out of the shutdowns? Because, right, inflation is a function of two things, demand and supply. We had huge demand because everybody wanted to buy stuff again, and we still had continued supply constraints, whether it was cars or supply chain. It didn't matter, but you just get back to that point where it's all about balance. COVID forced everybody to save. We came out of COVID and this whole revenge spending. People are like spending because they're making up for lost time, and it'll eventually even out. But it's all a balancing act.
Yeah, forced to save, but also allowed to save. I saw numbers thrown out earlier today in a headline that traveling to work as opposed to being forced to stay home for COVID costs the average employee something like $51 a day when you add up all the various components of wear and tear on the vehicle, gasoline, the added cost of insurance because you're actually using that vehicle. You add in, I'm going to eat out every once in a while now because I'm not just home to throw that meal in the microwave. And so, I think there are real kind of economic impacts to the very things we're talking about with respect to COVID. And maybe to put a neat little bow on this, we are still trying to figure out where does this settle? Where do we end up going forward with respect to demand for travel? Where do we end up with our ability as a working force to be able to save? And what does that mean for what happens going forward? Joel, on the economic front, not a terribly busy week. Anything in particular stand out to you from the economic data?
Well, we have the Consumer Price Index, which the Social Security number was based on, and that's still, lower than it was a year ago. It's made some progress. It was year to year, it was 3.7% in September, and that was tied with August for the lowest in 30 months. So that's pretty good, but it's still not 2%, which is what the Fed has said that it wants it to be. But it's down from 9% in June of 2022. So that's progress, but it's sort of stagnating right now. But one of the things that was keeping it up were was gas prices. And if you drive around, and I don't think that $51 a day pertains to Steve because he bikes, right? but if you're driving around, you're noticing the gas prices are going down. So presumably that'll help lower the inflation measures.
In the for what it's worth category, Joel, I did bike today. And what I tell everybody is there's no such thing as bad weather when you have the right gear.
There you go. I like that.
Well, maybe that does add to the cost a little bit then, making sure you're prepared for the rainstorm that's going on out there right now. We were joking before the podcast that we'll probably see some surfers on the drive home. There's some pretty good waves out there on Lake Michigan today. A pleasure to do the podcast for you, staring out over the lake. We'd love to have you in the office and stare out over the lake with us. If there is ever anything we can do, you give us a call. But as always, we enjoy doing the podcast for you, and we'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.